Joining us this morning is the Schork Report publisher, Stephen Schork. Stephen, good to see you.
Great to be here, Maria.
What are your thoughts on oil? Expecting a rebound anytime soon, or are we looking at low oil prices now for some time?
And yes, we are looking at low oil prices for some time now, Maria, and that's the difference a year makes, and the narrative has changed. As you pointed out, the AAA price is $2.28. We've had about a $9 plunge in oil prices. Now, historically, we look at a $1 relationship on the lag between crude oil prices and retail gasoline prices. So a $9 plunge translates to about an 18-cent decline in gasoline prices. So that would bring summer gasoline prices down to about $2.10, which is where we were last year, right around this time. Now, the big difference, Maria, is, as I've said, the narrative has changed. Last year, oil prices had bottomed in February in the dead of winter when gasoline demand was at its weakest and was trending higher throughout the summer and really got support because of all this hype and speculation that OPEC actually had the ability to boost oil prices higher. And indeed, they tried doing that in November. But what a difference a year makes, because OPEC has done what everyone thought they would do. They pulled back production, and it's failed. The market has called its bluff, Maria, and so now we're looking at lower for longer. Yes.
Wow. Stephen, it's Kevin Kelly, and you're correct on the narrative have changed, but I think one of the biggest things that has changed is that the U.S. is going to export 1 million barrels of oil a day out of Texas and Louisiana. That has completely shifted. Going back to that 2015 law that now lets us export, will we ever see oil back up at 100? I mean, I think what that did is that shifted the dynamic. Geopolitical risk is now out of a barrel of oil. So you mentioned OPEC. Those things don't matter anymore. We're energy independent now. This is great for consumers. So will oil ever see those days, and will we ever trade above kind of the 50 to 60 level? Because, I mean, the frack is on.
Yeah, the frack is on. Good one.
Indeed, Kevin, and to your point with regard to U.S. crude oil exports, it's a very good thing because the United States has the most complex infrastructure with regard to refining crude oil, and we could refine crude oil, a very heavy, a very high sour crude oil, which is a very low-priced crude oil. So those exports you mentioned are a very good thing because a lot of this excess oil here that we are producing is a very high-quality oil that we don't necessarily can use to maximize our refineries. We need that cheaper oil. So by allowing us to export, we're essentially allowed to export caviar and buy back tuna fish, and that's a very good thing for the industry and for the consumer.
You know, Stephen, I have a question about the support industries. We talk about oil and the big companies and the export issue, but what about the support industries? There are a lot of companies, the mid-cap companies that build the equipment. There are people there are companies that employ people. That's part of the picture in this country.
Oh, absolutely. There's a knock-on effect, and one of the tragedies of the last 4 or 5 years is what we've been seeing on that support industry. As you mentioned, it's been a major drag on industrial production, and I venture that industrial production virtually never came out of the Great Recession. And let's look at Caterpillar, kind of the bellwether for industrial growth there and equipment making, right? So we're looking at a situation where year-on-year sales on a month-on-month basis were declined for, it was either 51 or 52 consecutive months, 2.5 times what they experienced during the Great Recession. For the entire tenure of Obama's second administration, Caterpillar had declining sales month in, month out. Those sales are now starting to pick up. And indeed, if we start to get this infrastructure spending, if we start to get bringing back these jobs, it certainly is supportive of the industry and of the economy in general.
You know, I'm curious, this is really good for the American economy. What's it doing to some emerging markets like Russia, who really rely so heavily on oil?
Yeah, it's a double-edged sword right now. And now, if you asked me 2 years ago when crude oil prices started to really tank, my concern was it wasn't just crude oil prices, it was the entire industrial metals complex had just absolutely collapsed. Now the metals complex, the heavy industrials, lumber, copper, alumina, iron ore, steel, rebar, so forth, have steadied. The prices have steadied. So again, that's a good sign for economic growth, whereas crude oil prices are weak now, but we know the narrative why they're weak. We just have too much crude oil out there, and the United States, for instance, is continuing to produce, and we're going to continue to produce because the market is well hedged. So that is a good thing for the U.S. economy and industrial growth.
Right,
but to your point with regard to emerging markets, it's a problem.
You don't see cheap oil indicating a real weak economy, because that's how some people look at oil. This is purely
Yes.
the story of production? As Kevin just said, the frack is on, the fracking companies producing oil in this country. What else are you seeing in the energy sector right now, Stephen?
And that's it, and that's an excellent point, and we're actually seeing the disconnect, and people have to be cognizant, Maria, of making these correlations between the demand, and I know there are some people kind of wringing their hands now that gasoline demand is not as strong as they expected. Now let's keep in mind that this is not your grandfather's gasoline market. Heck, it's not even my gasoline market or your gasoline market from just 5 years ago, because Maria, you need two things to impact consumer behavior. In the oil industry, we've always had the one variable, the price shock, going back to the early 1970s. But up until recently, we've never had the second variable that will impact consumer behavior, and that is the substitute.
Right.
And now if we look at the Tesla, if we look at the Chevy Volt, so forth, that is eating into demand. So that is really the big question, is we have too much supply, we have good demand, but it's not as what you would expect just 5 years ago. But that's not indicative of economic weakness, but rather a shift towards the substitutes in our market.
And you have to believe, Lee, that this continues. We've heard the Trump administration and its plans to tap into the energy market. They want more drilling.
Absolutely.
They want the frack to continue, Kevin.
They absolutely do.
Yeah.
Yeah. No, there's a complete knock-on, and we look at Exxon's $20 billion investment building 11 petrochemical plants down in the Gulf Coast. In my home state in Pennsylvania, Shell has been sitting on an ethylene cracker for the past 5 years. The plans to build one, and they've hedged themselves, and they wouldn't do it. They're pulling the trigger on, they're building that. So that is just it. The big difference here is, Maria, capital goes where it is welcomed, and it stays where it is well treated. And when we saw just the how we made politics out of the Keystone XL, it was clear to the industry that capital was not welcomed in the hydrocarbon economy, and that's the biggest shift with Trump. He's calling for it, and the industry is responding in kind, which is fantastic, because it's a tremendous knock-on for the overall economy.
Yeah, no, it's a job creator. Let's face it,
Absolutely.
fracking. Stephen, great to see you. Thanks so much.
Indeed.
Stephen Schork joining us there.